Good morning, everyone. It is wonderful to be here this morning, and I'm so excited to share our story with you today. I'd like to start with our company's bold vision, because today we are not just discussing any gold mining project. We are talking about a world-class gold and silver mine that is shaping opportunity, legacy, and innovation in British Columbia's Golden Triangle. Our flagship asset, Eskay Creek, is in its sweet spot on the development timeline because we are just starting to invite re-rate capital, being less than 1 year away from final permits. We are the next major gold mine that's coming on stream, and we are poised to set new benchmarks in terms of responsible resource development and drive sustainable economic growth as we advance Eskay Creek towards production. I will be making forward-looking statements today, so you are duly cautioned. And the investment thesis for Skeena Gold and Silver is quite simple. It is all about redeveloping the former underground Eskay Creek operation that was previously owned and operated by Barrick, and we are reconceptualizing it as a sizable open pit. We are projecting annual production of 450,000 ounces of gold equivalent metal per year in the first 5 years. Eskay Creek is a great story. When it was a former underground operation, it was one of the highest grade gold mines in the world. And today it remains one of the highest grade open pit mines globally. At 5.5 grams per ton equivalent, our grade is triple the open pit global average. One can appreciate that when the grade is this good, the costs are also very robust. So our DFS is modeling $538 per ounce, all-in sustaining costs on a co-product basis, which is bottom of the industry cost curve. Eskay Creek is a significant cash flow generator. We will be generating at spot prices today $739 million in after-tax free cash flow per year in the first 5 years. There's also a significant silver component. I'll speak to that later. And this summer, we announced a very significant milestone in terms of de-risking with our project financing package. So I'll start with that because it was a very big catalyst for the company. It was a stock event, and the financing package for $750 million US is equivalent to 1 billion Canadian against a projected initial capex of 713 Canadian. So from that regard, we are overfunded. The full package was done with one partner, Orion Resource Partners, and we opted to go with them because they were willing to lend a significant amount of capital upfront ahead of final permits so that we can continue to stay on track with the project timeline. The package was very well received in the marketplace. It was very innovative, and there was certain components that allowed for optionality and flexibility, so I'll speak to those. Firstly, the equity piece for $100 million, 75 million of that closed at a premium to market, as compared to a traditional bought deal, which is done at a discount, which showcases Orion's willingness to be part of the story. The gold stream for $200 million has a buyback provision where we can elect to buy back 2/3 of the stream at an 18% imputed IIR after we attain commercial production. And that was a really important feature for us because as a single asset developer, M&A is always a consideration. So with this particular feature, we are not handcuffed or encumbered should this situation arise. I should also mention that the gold stream does not touch the silver and only applies to the gold. The senior secured loan for $350 million is a variable rate loan at SOFR plus 7.75%. And there's a 1% standby fee and no break fee, meaning that between now and drawdown, if we go into the marketplace and find more favorable terms, we can elect to replace it and walk away from it and basically put something in place that's more attractive. The same applies to the cost contingency for $100 million, but the cost contingency is in the same shape and form as the gold stream. So the full package allows us to come to the market and say, hey, we're fully financed to see this project through to completion, but we also have opportunities to sweeten and enhance the package should the opportunity arise. So Eskay Creek is located on Tahltan territory, which is a business-focused Indigenous group that has undergone generations of mining activity in the area. This First Nations group has a strong and sophisticated voice when it comes to supporting beneficial projects, and they understand socioeconomic growth. Because mining has been a key foundation to this area for generations, and for example, many of the Tahltan have worked at the former Eskay Creek operation, we have a supportive relationship, a very strong partnership. And I would say that we're very proud of the work that we do with regards to the Tahltan and ESG. And we actually have the first ever co-consent based decision on permitting, where the Tahltan central government and the province of BC are co-leading the permitting decision together. So yet again, another example of how Skeena is pioneering in the world of ESG and how we are doing things differently. Being a brownfield site, there's a significant amount of pre-existing infrastructure in place that will provide substantial cost savings. I always feel like this slide is a bit of a humble brag, but it is important to point out that Barrick had kindly permitted the tailings facility for us that saves $150 million off the CapEx as well as permitting time. And we have clean and cheap hydropower nearby that is 17 kilometers away from site, which is about a 15-minute drive, which is a very, very big luxury at 6 cents per kilowatt hour for power. I'll point out that we basically took full ownership of Eskay Creek in 2020. We acquired it in 2017, but since then we've done 4 technical reports on the project, the most recent one being a definitive feasibility study in late 2023 to encapsulate the inflationary pressures post-COVID. So it's a recent study with recent estimates that's driving our development path. Within the DFS, using base case pricing of $1,800 gold and $23 silver, we still had a world-class asset with a $2 billion after-tax NPV. If we look at it at something more closer to spot, it's a $3.6 billion after-tax NPV, 63% IIR, and 0.8 years payback, which is essentially less than 300 days once we get up and running. And I'll emphasize the cash, because at spot pricing, Eskay Creek will be doing $739 million in after-tax free cash flow per year in the first 5 years. As a quick tour of the site, I'll say that I was here last summer, and for me, the biggest takeaway was actually how small and compact it was, because when one thinks of a 500,000 ounce producer, you're picturing this massive operation, but it really isn't that. So for cost efficiencies, for low hauling distances, this was exactly that. So the deposit itself is north dipping. It's a VMS deposit, and we have mineralization right at surface. We will start mining in this direction, and the pushbacks will go in this way. And if we spin to have an underground view, you can see that there is an underground component. So we're looking at, and this is just low-hanging fruit, we're looking at steepening the pit walls, which are done very conservatively so that we can access more of this underground resource. We are building a brand new state-of-the-art modern mill, and what I like about the mill is this tertiary regrind. So it's an additional step in the grinding process so that we can attain an ultra-fine grind. This is a luxury with the cheap power that I talked about so that we can liberate more metal, and this was one of the key improvements from the feasibility study to the DFS. And then up the hill, we have the tailings facility, which is more than ample capacity, not only for the tails, but for acid-generating rock. And I will point out that in terms of safety factors and slope stability, depositing tailings subaqueously is one of the best ways from an ESG standpoint. The production profile is front-loaded, and that was done intentionally. You can see that the grade and the ounces are elevated in years 1 through 5. We're in the permitting process now, and so the permitting process is based on this production plan. We know that we have opportunities to backfill the production profile in later years with things like our SNP mine, located 40 kilometers away, which is a very high-grade gold mine. We can back bolt it onto the production profile, but we would do so after the permitting process is done so as to not interrupt the plans while they are still being permitted. And positioning. This is one of my favorite slides because it really helps one understand why Eskay Creek is such a desirable asset, why it is such a phenomenal story. So here you can see the highest grade open pit gold mines globally, and at 5.5 grams per ton in the first 5 years, and even 3.6 life of mine. We are basically near the top. If you look at the operators of all of the mines who operate such high-grade mines, you've got your Barricks, you've got your Agnicos, you've got your Newmonts. So it really helps one understand why this asset is so phenomenal. The value split is about 65% gold and 35% silver. But because of how big it is, that 35% byproduct credit on the silver actually makes Eskay Creek one of the largest silver mines in the world. So here we're looking at positioning, and you can see that in years 1 through 5, that 9.5 million ounces of pure silver is very significant. It's very meaningful. And we see the fundamentals for silver as being very attractive. Not just nominally is silver important, but per share, because we've got 88 million ounces in reserves and 107 million shares outstanding. We actually offer more silver per share than many of the primary silver producers in the mining industry. We know that the silvers command higher multiples. We know that there's a scarcity factor. And so we're starting an education campaign about how much silver we have to propel our re-ratings forward. Eskay Creek also has significant quantities of antimony, lead, zinc, and a smaller amount of copper. These have not been incorporated into the economics, but as we monetize these minerals in several years out, it will continue to boost the NPV of the project and improve payabilities on our bulk sulfide concentrate. So, valuation upside. I'll start by saying that there is not a lot of mines that can say as a single asset producer that they will have 450,000 ounces coming out of the gates. There just aren't that many mines that big. But we do have a couple of comps on the upper bound and the lower bound that we look to for our valuation inspiration. The one asset that we feel we're closest to in terms of operating parameters, in terms of production, in terms of costs, in terms of reserves, is Fruta del Norte, operated by Lundin Gold. So they're sitting at a market cap of just shy of 8 billion Canadian. We're sitting at a market cap of 1 billion Canadian. That would be the upper bound. The lower bound would be the Osisko acquisition for the Windfall project. So this was Canadian pre-permit asset, smaller than Eskay, and a little bit earlier in the development stage than Eskay as well. So the acquisition price was 2.5 billion. There's Artemis with their phase 2 expansion at 450,000 ounces and about a $3 billion market cap. When you plug in spot prices into the model, we are trading at a PNAV multiple of about 0.3. But we have a world-class asset, and we know that as we continue to get closer to production, closer to cash flow, execute on development, we see a clear pathway to 1 times NAV on the gold. We see a clear pathway to 1.2 times NAV on the silver. And so one can infer that from today's levels, we see potential for a 5-fold increase from where we are today, just based on the comps in the marketplace today. We are 70% institutionally held. All of our shareholders are long-term shareholders. They are anchors. They understand the value of the asset. They would not entertain a takeout target at today's valuation with a 30% premium. They just wouldn't. We've got 107 million shares issued and outstanding. We've got 11 banks that cover us, and a very liquid stock on both the TSX and the New York Stock Exchange. So that wraps up my presentation. I really want to thank you all for your time, and if you have any further questions, I'm always available. Thank you.